oil service at Rapidan Energy Group, Gulmira Rezaev, founder and MD of Eurasia Analytics, and joining us for the first time on this particular podcast, Mr. Badr Chowdhury, who's head of the energy sector at Mashreq Bank here in the UAE. So great to have you all with us today. Clay and Gulmira, I believe you just spent the week in London, and you're still there at IE Week. So I'd really, look forward to also hearing about your main takeaways on today's podcast from that. Clay, let me start with you. And yeah, let me ask you, I've got the headlines there from today, obviously, but give us a snippet of what your main sort of takeaway sentiment has been, having attended IE Week this week in London, for demand, supply, balances going forward. Is there a bit more certainty as we go through to the end of this year now of where we stand?
Well, good morning and good afternoon to you and the audience. It's a pleasure to be with you again. The sense that I get from talking to the colleagues here this week is a pretty narrow range of expectations for the supply-demand balance this year and also for the price range. I mean, at Rapidan Energy, we're expecting low 80s both this year and next year. We think that we'll run a bit of a deficit of demand over supply in 2024, maybe say like 700 KBD. We see next year as actually quite balanced. The key assumption, though, in that outlook is that OPEC Plus is going to maintain its current program of supply restraint for quite some time. And when we just rebooted our modeling and our fundamental forecasting last week, we ran some scenarios asking how soon could the group start to think about bringing back some supply into the market. And our conclusion, given our assumptions again for global oil demand growth and also new inputs from non-OPEC supply, is that OPEC Plus will probably prefer for quite some time, we're assuming for the balance of this year, to leave those supply cuts in place. Because according to our modeling, if they were to rescind those cuts and taper them and bring that oil back onto the marketplace, we would wind up with inventory levels that are probably higher than the group has in mind for a balanced market. And so for that reason, we are assuming that the supply cuts will stay in place. It's certainly possible that as we get maybe a bit tighter in the global balance, let's say toward the end of this year, maybe the fourth quarter, where we're expecting prices to be a bit higher than they are now, maybe at that point they could certainly consider bringing a little bit of oil back onto the marketplace, but we don't see that anytime soon. And likewise, there was general consensus here that we would see continued growth in oil demand worldwide, with non-OECD certainly being the big contributor, and likewise that non-OPEC supply will probably come in somewhere around the pace of demand growth around the world this year, and that we will not see a similar surprise like last year from one of the important growth centers for non-OPEC supply, which of course is the United States. It surprised to the upside last year. I think that there's consensus that it would really take a special trick for the United States to be able to repeat that performance this year with the mergers and acquisitions and some of the other considerations in the United States oil patch. That kind of upside surprise looks unlikely.
Okay, thanks so much for that, Clay. Gulmira, let me go to you also and let us know if you agree that that's kind of, without necessarily repeating those points, but would you say that it was the sentiment you took away from IE Week this week? And I also then wanted to ask you about your impressions of, and I'll go back to Clay on this as well later, on how the new US sanctions, or the renewed, or on top of what was there, is impacting Russian shipping from your point of view, because we've had quite a few people on the show this week saying, nothing major yet, but it is beginning to bite a little bit. It's causing a headache, at least. So quick takeaway from IE Week, and then give us your takeaway on whether you think Russian shipping is now being impacted by sanctions.
Yeah, good morning. Thank you. So I think my takeaway from IE Week would be that there are certainly concerns coming not only from supply side, but also demand side, because suppliers are also, concerned about the demand uncertainties, because coming from the country, from Azerbaijan, that is one of the major oil producer and exporter. This is really something that disturbs oil and also natural gas supplier as well. So what's going to happen with demand in longer term perspective? Because there are billions of dollars of investment in not only new project but also in the current projects to maintain the production, and obviously demand uncertainties concern oil suppliers as well. So this is something we heard yesterday at the GI dinner as well from former Minister of Bahrain, and I would say that this is some issues that also it turned out an important thing to consider when you go ahead with your FIDs in new and current projects. On Russian supplies, well, I think so far sanctions, well, I'm not talking about the most recent sanction, but sanctions that imposed before, haven't bite that painfully Russia, because we're talking about some amounts of oil which were just redirected from the Atlantic basin to the Asian market, and given that oil demand in China and India was growing, so far it's been growing. So Russia managed to find the market for its oil, in the Asian market. But recent sanctions, imposed on the banks and all international transactions that would be done in dollar in oil trading. I think this is so far caused a lot of let's say uncertainties for Russia, because still, as far as I know, Russian trading companies, they stopped at the moment trading with oil, so they try to figure out the new schemes of bypassing the sanctions and coming up with some schemes of as they did before with all sanctions, to continue trading, trying to bypass sanction. And I think that in just as I heard, in just few days, looking forward, they will come up with some new schemes and continue trading. So I don't think that this will significantly disrupt Russian oil sales or trading. I think just there will be as has been so far, all the sanctioned oil price or oil and oil products trading, as was conducting, without any major problem. Just they were putting from sanctioned tankers to non-sanctioned tankers. Documents had been changed, and the documents you have Russian gas named like origin Kazakhstani gas or Omani gas, oil or products. So I think this will be the case in with these sanctions as well.
Okay, so they'll continue to probably get around those. Badr, good morning again and welcome. We haven't had a chance to talk to you since the COP28 meeting. We certainly haven't had you on this show for that, and I'd like to get your perspective from the finance banking sector about the appetite post COP28. New targets were set, new initiatives, a few things put into the statement about fossil fuels, and of course investing in the energy transition. So give us sort of the start of 2024 outlook for you from the banking sector, the appetite for CapEx in conventional energy products versus green, and whether you think COP28 or those initiatives are having any impact on the appetite for either of those areas of investment.
Yes, good morning and good afternoon, everyone. Again, thank you so much for having me on this podcast. This is the one that I haven't attended in the past, but very, very familiar with the format. So again, in general, I think if you look at the economics or the dynamics of the market that we operate in, by all measures, I think we are sort of ready to actually continue the pace that has been set in the last 3-4 years. The direction has been well laid out by the leaders of the regional markets, and you're seeing significant sort of investment. If you look at Saudi Arabia, if you look at the UAE, the wider GCC, there is absolutely clear mandate that has been reinforced what was said in the COP28, and you are seeing significant more sort of momentum building to deliver on that mandate, right? So policy making is being sharpened, as they say. It is being adjusted towards the mandate that was advised or put across the COP28. Having said that, I think what we witnessed at COP28 was the significance of how a balanced transition and a sort of a calculated walk towards the energy mix was identified, right? Energy security was highlighted as a concern that everybody witnessed in 2023, and that was taken on board, right? So in general, I think the region will continue to lead in its role towards the energy transition, while continuing to remain an active participant in the conventional sort of energy sources as well. I would, of course, like to also comment that 2024 is the election year, and in particular the US election year, right? And that will effectively dictate what we foresee in the next couple of years, the outcome of that election, right? And the demand side story will definitely be impacted as to what the transition happens after the elections. Mind you, we're already hearing from the central banks about a potential soft landing, right? And how that, along with the outcome of the election, will translate into the decision making around the interest rate levels and the tapering off of the interest will all play into the demand side story on the oil and gas space. So interesting times, but here in the GCC, we expect to continue the momentum of diversifying the economy, moving towards a greener energy, while maintaining our contribution towards the energy mix for the energy security of economies that rely on hydrocarbons as of now.
And of course, the consumers who rely on those hydrocarbons, not in these economies here in the Gulf, but of course, in the emerging markets world. Clay, let me go back to you on that point of US elections. Let's not get too much into the mess of the electioneering, but from a sort of results point of view and also US economy point of view, I wanted to come to you and ask you what the sentiment is now about the soft landing. I mean, I think we can all agree maybe it's already had its soft landing, the US economy. By all intents and purposes, a good year last year, despite expectations a year ago. What's the sentiment there on the ground now for the next few months, given that we kind of know where interest rates are going to go, which direction, and nothing too dramatic is going to happen?
Right. I appreciate the question. I mean, it seems clear that a bit tighter for longer and higher on interest rate policy is baked into financial markets, including commodity markets. And nevertheless, we're seeing, prices in a pretty stable range. So that bit is already baked in and priced in. I think that when it comes to the uncertainty around the outcome of the United States election, there are so many elements to consider that are relevant for the energy industry and economic performance generally. One of them certainly is on the foreign policy front, which will probably look very different under either of the two administrations that we can see as a result of the election. Likewise, when it comes to other policies that affect the economy and the commodity pricing front, we are especially starting to focus on the potential for a major debt crisis in the United States in the coming years. It could be as early as the first year of the new administration, so 2025. And it occurs to us that the presumptive candidate on the Republican side, which would be former President Trump, will probably lean pretty heavily toward the imposition of trade barriers, significant ones in the form of tariffs. And that has the potential to pull down economic performance, economic activity, and act as a barrier to GDP growth versus those expectations that are already priced into the market on what we've already seen in terms of interest rate expectations. So rates could be even higher for longer. And if there is really an issue with rating on the United States and potentially international parties that were to sell US denominated assets, et cetera, we could have lower oil demand and aggregate economic activity in the United States than the market is expecting. So we at Rapidan, you probably know, we definitely feel like the future of oil demand and oil demand growth remains coupled to the GDP trajectory. It's not decoupling like some other analysts have asserted. But if we have trade barriers, if we have a trade war or something like that under a new administration, it's possible that oil demand growth could be much less than people are modeling right now.
Okay, thanks, Clay. Gulmira, let's talk a bit about gas. We've had a few discussions on it this week already because the price trajectory for international, let's say, gas prices, is going down. There doesn't seem to be any extra strong pull from Asia or Europe as there was a year ago, and everything seems to be pretty much under control. We have a headline today with saying that Russia is diverting its LNG to China from the Red Sea around the Cape. You know, it's even getting its gas to Asia when it needs it. So what's the outlook for gas demand in Europe as you're seeing it, and this trajectory of gas prices generally that's softened, you know, a lot in the last 12 months? Is that kind of the new normal? Of course, there's weather-related things, but, you know, it would take a very, very big change in the weather to pull prices up from where they are now back to the highs that we saw, which were triggered initially, obviously, with the Russian crisis.
Yeah, I think demand decline will be continuing in the European market in the following years as well. Thanks for all the measures that European Energy Commission has been taking so far. So this bears some fruits, and therefore, well, given also the fact that inventories are pretty much full before the season, and now it's full like something like 70%. This gives an energy security, and so far affects the prices. So prices are not going up as was expected maybe before winter. But I think this is what we are facing in Europe at the moment, is demand destruction, which means that, well, it's not a demand reduction, which means that, you know, those volumes will not come back to the market again, especially in the industry sector, because as we're witnessing now, the industry in Europe is, migrating to some other regions of the world, especially to the US, which means that, yeah, this demand destruction, will not reverse in the future, which and this means that the demand is declining, and this trend will be continuing in the future. And I think here important thing is whether Europe is, how successful to manage to bring gas from alternative sources and via alternative routes, and this is a major issue because there are not too many alternative sources existing at the moment, and if we're talking about the pipeline gas, so we have only a gas coming from North Africa and Azerbaijan. Volumes are not that big. Well, Azerbaijan is planning to double its gas export to Europe from current 10-12 BCMA to 20 BCMA by 2027. And then if you look at the African supply, especially Algeria, then yes, Algeria is also planning to tremendously increase its gas export to Europe. But I think for both of these suppliers, they need an investment to increase the gas production and expand their export infrastructure to be able to increase gas export to to Europe. And this brings me to another point of, again, demand security. I mean, for investment in your infrastructure, including, gas production and gas transportation facilities, you need to have your long-term contracts in place, which looks to me a bit problematic on the current situation, because, again, there are lots of demand uncertainties, and the buyers are reluctant to sign long-term contracts, which makes problematic for gas suppliers to, invest in and to secure funding and invest in their infrastructure. And LNG also another issue, because we are facing now rather a tight LNG market, and given that, as you said, Russian LNG is redirected from Europe to the Asian market, then we are also facing here a great competition for LNG. So for LNG prices are fluctuating a lot, and this creates another uncertainties for the market.
Okay, I mean, it's tight, but I mean, we do have a lot of gas coming online the next few years, big projects, and of course, we saw announcements the last week from Qatar, which has got a new find and will be expanding its production. Saudi Arabia also has said that it's going to be looking to expand even gas production. Badr, I'd like to go to you on that, on Saudi also, and get your thoughts from sort of an economy point of view. Saudi Arabia also, a couple of weeks ago, their energy minister said that they would not be, for the time being, continuing with plans to hit this 13 million barrel a day target. That one has to assume that's because they want to spend elsewhere, and they've got budgetary needs, obviously, for these mega projects. So I'd like to get your thoughts on the Saudi economy and sort of its financial, I suppose, well-being and its economic well-being. Clearly, it's fine, but this whole expenditure budget and how it's looking to divert and grow its non-oil economy. And just before that, Badr, we'll just look at that survey question so we can click our answers on it. And that's asking everybody what the average Brent price might be in March. In February, it averaged just above 80. A month ago, when we asked people about the February price, most people said it would be hovering around 80. So our audience was correct. So what's it going to be in March? Are we going to still be closer to 80 as we were last month and in Jan, or are we going to get a different picture? So Badr, just back to the Saudi question there in terms of economic planning, finance, etc. And even the interest of foreign direct investment in the economy. Give us your point of view on the Saudi economy outlook.
Yeah, so from the perspective of Mashreq, I think we clearly see the direction of travel for Saudi Arabia extremely positive, and it is, as I say, as timely as it can be. Clearly, the direction is to diversify their economy, move it as much as possible into a balanced economy rather than extremely, centralized around the hydrocarbon space. And clearly, there is significant potential. We, in the last 12 to 18 months, are witnessing significant investment, as you mentioned, FDIs, in terms of mobilization of resources to implement that diversification strategy. And in general, I think the market is getting ready for being ready to consume the sort of requirements with respect to the financials that are available, right? We see that the local corporates and of course the international corporates are raising liquidity, and liquidity is definitely available for these projects because there is a well thought out plan as to how to diversify the economy. You are seeing certain sectors that have been are leading the race, which is of course your tourism, which is both your holy tourism and the conventional tourism, which is definitely gathering pace. Then of course the infrastructure. Clearly there is significant room to improve infrastructure, and we expect that the financing for this will be available. A part of it, as you mentioned, will be reallocation of the budgetary, sort of expenses towards that, as well as the overall economy. The petrodollars continue to flow in, given where the oil prices have been, and expected to if they remain range bound in where they are, I think the inflows remain quite strong. So in general, you also have to sort of appreciate the fact that the regional economies are keen to partake in this transition, right, in this journey for Saudi Arabia. And you see a lot of collaboration happening between private corporates and public entities as well. You've seen the likes of Aqua, Masdar, all very keen to capture opportunities in new technologies. So hydrogen energy, so again, your solar, wind energy, all are attracting significant investments from corporates from the region, right? And they bring their own balance sheet, they bring their own finances on the back of it, right? So as long as the policy is implemented with favorable, sort of rules and regulations, we see that the Saudi transition towards diversification to continue successfully.
Okay, thanks, Badr. Clay, what? Just let's get your opinion on this announcement a few weeks ago by Saudi Arabia about its plans for oil, for pushing its oil capacity up to 13 million has been shelved for the time being, focusing on other things. What, do you think that's just very temporary, literally because of budgetary needs, wanting to sort of spend elsewhere at the moment, or do you see that, as we've heard since then, as a sort of reiterated intention of we are, changing our economic model and this is here to stay?
Well, our assessment is that it is temporary in nature, and that it can certainly be implemented when the supply-demand conditions and the signals that are sent by the marketplace signal that it's necessary. And that's not the case right now. In a relatively balanced market, that's still going to have, it's still going to be loose in the coming period. Probably the next several years, we will still have pretty assertive growth from non-OPEC supply, and keep a market stability in the recent range. However, according to our medium-term outlook, toward the middle or the end of the current decade, we will see supply-demand balances tighten. And when that happens, and everyone realizes that there has been, in many cases, some underinvestment that was needed in the upstream, and that demand is turning out to be far more resilient than maybe the conventional wisdom has positioned for, then we will need more supply from OPEC Plus, including Saudi Arabia. And at a time when the market signals that things are tighter and more liquid supply is required, then they always have the opportunity to bring those plans back to fruition.
And Clay, just staying with you on the OPEC front, we've got there, obviously you've given us sort of what your expectations are and what they'll do in terms of output. The other point that they're going to be discussing in June, formally, at least that's the plan at the moment, is the quota issue and recalibrating those quotas back to what's real, I suppose, is what's been expected. Do you expect we will see some changes there? And does it make a difference, really, considering we're managing this market on a monthly basis?
Well, it's possible that it could make a change, I believe, already for 2025, if not the current year. So when they think about baselines and future targets, then apparently they will be considering the result of these outside capacity audits, if you will. And so there is a lot at stake across the portfolio of OPEC Plus contributors and members in terms of reevaluating and maybe rebasing those production capacities. So there's quite a lot at stake for future years, but we don't see the outcome of this audit affecting anything in the near term, including the balances and the price forecasts that I mentioned for 2024.
Okay, thanks, Clay. Well, there's your result for today. Nobody thinks we're going to be close to $70. I suppose that's quite positive, although we do have, we've had, the trend has been gradually up in the new year for prices from December, obviously, but there's this bearish sort of weight, isn't there? Despite OPEC cuts, despite geopolitics, But there you go. We're sticking to close to 80 for the coming month. Let's see if that comes around. Gulmira, I'll go to you just to close off for us. And just get your thoughts on, I mean, I know this isn't your area of expertise, but from an impact of how it might be affecting Europe. But China, we haven't mentioned China today. China economy, it impacts everything that happens in the energy world, doesn't it? From a demand and pull perspective. What sentiment are you getting from the people that you talk to about where the economy is headed this year in terms of predictability for energy markets? Are we now a bit more settled in knowing what we should expect from Chinese demand and the economy there?
Well, yeah, we have some discussions on China yesterday, and my understanding is from discussions that energy demand, including oil and gas demand in China, is growing in some areas of economy. But it will continue to growing, but on a very slow pace. Unlike it was expected, and I think. China will continue to. Chinese buyers appear to be boosting their oil import from mainly Saudi Arabia in April and in the following months. But just it seems that China also switching of buying mainly from Russia now to Saudi Arabia, which is interesting fact, because it seems that now Saudi Arabia is trying to reclaim its market back from Russia by introducing a reduction in official price formula for the Asian buyers, and that's an interesting fact. So I think we're going to see more China's and also India's imports from Saudi Arabia in the coming months. So with that, probably Russia will face a lot of obstacles that will not related to sanctions or to the war in Ukraine, but more obstacles related to this competition for the market in Asia.
Yeah, as you said, the Saudis have been becoming more competitive with their OSPs in the last few months. And of course, the Russian discount has been becoming less attractive really for the last few months. So we'll see how that impacts those volumes going forward. Thanks so much, everybody. Thank you to Badr Chowdhury for joining us today from Mashreq Bank, Gulmira Razayeva, and Clay Siegel. Thank you so much, everybody, and have a good remainder of the week.
Thank you.
All the best.